Welcome everybody, my name is Jerry. I'm going to talk to you about the 6 things that make me a great trader, the difference between a profitable trader and a hit and miss trader. Number 1, always trade in the direction of the current trend. So what does it mean to always trade in the direction of the current trend? Well, before you see, I took a snapshot of one of the futures products I trade. This is the E-micro Dow Jones. You'll see there's a, right in the middle of the screen, it's really obvious, there's a big green arrow going up, okay? And pricing is clearly moved from the bottom and moved upward, okay? And you can see there it says trade with the trend. So what does that mean? We take a long position, not a short position. We buy long because the trend is going up. We wouldn't short, right? We would, in this case, we buy low and sell high. What we wouldn't do is short at the bottom of this trend and then hope and pray we can buy back low. Well, you're not going to be able to buy back low. The price is going up. So this may seem basic, but I can't tell you how many times people make mistakes and they have what's called FOMO, fear of missing out, okay? And they take positions in the weirdest times and they're all messed up in their trading strategy, and because they put way too much emphasis on making a quick buck. People are weird when it comes to money. You want to be a good trader? Start with this number 1 on the list, trade with the trend. Number 2, never over leverage your account margin. So what does it mean to never over leverage your account margin? Now in front of you see that I have a spreadsheet, and you can see the big yellow column there, column D, it's in yellow, it says margin rec. Well, that's short for margin requirement. Okay? This is an actual live snapshot or picture of my current positions that I have in my account. In column A, you'll see I have the futures product symbol, and look at line 4. It's in green, M6E. That's the E-micro US or E-micro Euro US dollar currency future. I have one contract sitting there that's long, and the margin requirement for one contract is $251. Okay? If we come down to line 12, you'll see I have in red MYM. Well, that's the E-micro Dow Jones. Remember we talked about that a little bit earlier. You can see I have 2 contracts short. That's why it's in red. And the margin requirement's $2,354. Okay? You notice in column D, it says margin. That's margin per contract. Okay? So it's simple. I just multiply the quantity of contracts times the margin. That's how I get to 2,354. Okay? So in the next line down, in red also is MES. That's the E-micro S&P 500. And now I have 3 contracts short. And that requires me to have margin or assets or cash in my account of $3,960. Look at the bottom. All the way at the bottom, column D in yellow, the total margin requirement is $6,565. That's how much money and or assets I need in my account to cover these trades. Okay? That's the margin requirement. So you never over leverage your margin, your account margin. Clearly I have more than $6,500 in my account, otherwise I'd be right on the cusp of having a margin call. Right? So my total cash and or assets in my account has to exceed the $6,564, which it does. Okay? So most brokers, are going to give you some kind of idea what your margin requirements are in your brokerage account. You should be able to see it, buying power, stuff like that. But you better keep track, and you better know that you're nowhere near a margin call. Number 3, always take a position in the main portion of the trend. So what does it mean to take a position in the main portion of the trend? Well, you see the green arrow, right? Well, let's look at the very bottom where you see some red candlesticks. Right in the middle of the screen, at the very bottom, you see red candlesticks, right? That's what those kind of funny looking long rectangular rectangular shapes are. Those are called candlesticks, okay? You see some red ones down there, right? So we don't want to take a position down there, a long position down there at the bottom of this trend, right? because we could be getting in too early and the trend could continue down. So that's not taking a position in the main portion. That would be taking a position at the very, very beginning, and you better be really, really accurate in your trading to take it right there. So let's move up like maybe a couple candlesticks where you see a little yellow arrow pointing up. Okay, that's still kind of early in the going into the uptrend here, but that would be okay. Slightly aggressive to take a position there. Okay. And if you move up another candlestick or two vertically, taking a position somewhere in there would be acceptable. Now, how do you know the main portion of the trend? You see those three lines, blue, green, and red? Now, these happen to be three moving averages. You see how they, at the bottom, they're all squished together and tight, but up there in the middle, they're spread out? Well, that's how you know. That's one of the ways you know. Okay. I'm not going to get into, in this video, knowing when to exactly place the trade, but one of the ways we know is by looking at the moving averages. And as the lines spread out, we know we're getting momentum. We know we're getting a lot of movement in that particular direction, and we can place a trade, okay? So in this big trend here, this is an overly obvious big trend going on in the 5-minute chart here. You want to take the position somewhere in the middle of this trend, not at the very beginning and not at the very top. You want to catch the momentum. Number 4, it's better to take a position in smaller contract sizes than one large contract size. So what does it mean to take, it's better to take positions in smaller contract sizes than one large contract size? This right here is going to be one of the most difficult things for new traders. Even veteran traders don't get this. They just don't understand, and they make the mistake of taking on one contract, one large contract, okay, instead of small contracts. So we want to take on multiple contracts of small size contracts. So let's go down to line 13, for example. You'll see I have -3, MES in red, -3. That's 3 contracts. That's the E Micro S&P 500. I've got 3 contracts right there. Okay. Then the margin requirement for those 3 contracts is $3,960. Can you imagine if I tried to go trade even one contract in the E-mini S&P 500 right now? If you look at the bottom of the screen, line 22 says ES, and you move to the right. This was just a few months ago. It used to be $6,930 for one E-mini S&P 500 contract. You know what it is today? Twice that. It's over $13,000 today for one contract on the E-mini S&P 500. Which, by the way, they shouldn't call it E-mini anymore because it's not. There's nothing mini about $13,500 margin requirement. That's ridiculous in my book. They should just call it what it is: big, fat, huge contract, and it costs you a lot of money to get into it. Okay, so I'm taking 3 E micro contracts because there is no way I'm going to leverage my account at $13,000 for one E-mini S&P 500 contract. So why do we do that? Is it better to take on more contracts of small contract sizes like an E micro rather than a large contract like E mini? This allows you to add or subtract from your position and manage your positions and ultimately manage the risk in your account. Let me give you an example. If I had one contract, the E-mini S&P 500 at $13,500, that would severely leverage my account. Now, I couldn't reduce the contract position anymore because I'm already at 1. If I reduce, I go to 0, I have to sell it. And it could force me to sell it at a loss. Okay? It's going to be difficult for me to add a position on the E-mini S&P 500 because it's already $13,500. If I add one contract, now I'm at $27,000. So as you can see, for small accounts, it's going to be really difficult to manage your risk on the E-mini S&P 500 because the margin requirement is so high. But it's much easier to manage the risk for small account traders like myself on the E-micro S&P 500 because the leverage or the margin requirement is so much smaller. I can manage the risk better. So let's say that I needed to reduce my position of the MES on line 13 from 3 to 2. I could do that. I could sell one of the contracts. I might be selling to take a little bit of profit. I might be selling because I feel like I'm approaching of getting over leveraged and I want to reduce my risk, and I sell one contract. But at least I still have 2 contracts on. So it's better, especially for small accounts, but even people at large accounts, okay? It's better to take on more contracts of smaller size than one big contract. It allows you to manage risk better. It allows you to take profit sooner, perhaps, or taper off your profit, so to speak. Take a little profit off the table. You hear traders say that. Leave a little bit on there. Okay? You can't do that with one contract. Multiple contracts you can. Okay? So do yourself a favor. Trade the products that have low margin requirement so you can take on multiple contracts, allowing you to manage your risk better, allowing you to take profit better more often. Number 5, trade predictable low margin products. So what does it mean to trade predictable low margin products? So we have a screenshot in front of us. Again, this is the E Micro Dow Jones. Okay, so let's talk about the predictable part. What makes a futures product predictable? Or even a stock or anything else you might be trading. But we're talking about futures products specifically here. What makes it predictable? Well, you see some yellow arrows pointing down, right? Maybe hard to tell in this video, but there's some small red arcs at the bottom of the screen. That's called cycle analysis. Some of you that watched my videos before have probably heard that. I really sincerely hope you go look it up and study it. So this is a very predictable product. You'll notice that the lows, that there's dips in the price of the Dow Jones right between these cycles. Okay, in cycle analysis, we're always interested primarily in where does the price come to a low point. Now these cycles or red lines at the bottom, they are exactly evenly spaced out an X amount of days. Because we're looking at the daily chart in this case, okay? So you can see the first arrow, that's a low point. The second arrow, you can see the price dip down. Okay? You may not be able to see on the screen, but the first arrow is March 23rd. The next arrow is April 20th. The third arrow was about May 15th. And you can see the price dip down there too, right? And then the next arrow is about June, 13th, somewhere around there. And you can see the price came down dramatically. As a matter of fact, if you look in the description of this video right now, you're going to see that I actually predicted that the stock market would collapse before it happened. That's right. I predicted it at the top before it collapsed. And 2 days later, it collapsed. So look at the link in the description for how I predicted and when I predicted the stock market crash. And by the way, while we're at it, go ahead and click the subscribe button and hit the notification bell so you'll get notified of all the videos when they come out, and give me a thumbs up. I really appreciate that. Okay, back to the video. So this is a predictable product, right? Using cycle analysis and other things that help make this a predictable product. So that's the predictable part. The other part of number 5 was low margin products. Well, we already talked about margin. We already talked about low margin requirements. This Micro Dow Jones is significantly less margin requirement than trading the big Dow Jones contracts, or even I think there's an E-mini Dow Jones. I've never looked it up, but both of those contracts are super expensive. Okay, so once again, trade predictable, low margin futures products. Trust me, you're gonna make a lot more money doing that. Number 6, and perhaps the most important one, take profits often. All right, take profits often, our favorite part. Here's a spreadsheet in front of you. These are my actual trades that I've done this week. Okay, today is June 25th. The week started on June 22nd. And you can see I've made quite a few trades here already this week. This is only 4 days in because today's Thursday. The market closes Friday tomorrow. Okay, look at all these trades I've made. Most of them have been the E-micro Dow Jones, but there's been a 3 that were done, trades that were done on the the E-micro euro US dollar currency future, okay? But look at the column that says profit at the top. That's gross profit. Look at all these trades. 27, 11, $92, a nice trade by the way. 25, 35, 15, a bad trade at 6.5. 11, 10, 8.5, 11, 11, 11, 11, 10, 20, 20, 17, 22, 20, 20, 29, and then followed up with 4 trades so far today at $20 a piece. Now that may look like a lot of small trades, but look at the very bottom. $512 so far this week. And I gotta tell you, this has been a slow week for me. Paid some commissions and the net's $338. Okay? And all the way to the right, I tithe. I'm a Christian, so that's my 10%. That's what tithe means, 10%. Okay? So I like to give to worthy causes, those that promote the kingdom of God and believe in Jesus Christ. I'm not ashamed of Jesus. So this spreadsheet shows that taking profits often adds up to big money. I see way too many people getting caught up in commissions. Oh, if I trade too often, I pay a lot of commissions. So what? If you trade seldom, you profit seldom. Okay, that's the way it works. Okay, trade often. Make sure your trades are profitable. Make sure they're enough, more than enough to cover the commission, and keep doing trades. Okay, so this is $500, $512 gross so far this week. That's about $125, $130 so far per day. That means by tomorrow, if I trade the same amount, I'll be looking at about maybe $600, $650 for the week, which is a little bit of a slow week because I actually broke one of my rules this week. I actually traded against the trend, which was stupid. I made a mistake and I locked up some of my money in a couple contracts that are sitting there. They're going to clear out eventually here pretty soon because the market's going down, but I broke one of my own rules. Okay, it happens. All right. If I hadn't done that, I'd probably be well over $1,000 already this week. Okay, but I didn't break all my rules. Okay, I only broke one rule out of the 6, and what that means is I didn't over leverage my account margin. So what does that mean? That means it still allowed me to trade some 1 lots and 2 lots for the rest of the week instead of my usual 3 or 4 or 5 lots. So I was still able to trade. I just had to trade fewer contracts per trade. That's one of the benefits of not over leveraging your account margin. If you do make a mistake with the trend, you can still trade some other products or even the same product and make some of that, continue to make some money, even though you might be locked up on some leverage elsewhere. Okay? Right, so take profits often so you can make a lot of money. All right, don't forget, in the description of this video below is a link of another video where I predicted the stock market crash. Go watch that video. That's a great video. You're going to learn a lot in that video. I really hope you enjoyed the video today. We'll talk to you again soon next time.